If you've heard of the government's tax changes for property investors, you're probably thinking, oh, this doesn't sound very good. Are there any silver linings? Hi, I'm Ed McKnight, economist here at Opes Partners, and in today's video we're going to tell you about the one really good thing that's come out of these government tax changes, which I think you're going to be pretty happy about. And it's all to do with the bright line test, and that's the tax that we pay here in New Zealand on the capital gains on our properties. So let me just tell you what happened before the changes came in. Well, if you bought a property, then there was a 5-year bright line period. Now, what that means is if you sold that property within those 5 years, you pay tax on your capital gains. Now, if you sell the property after that 5-year period ends, all good, don't pay tax on your capital gains. But what was the issue? Well, if you wanted to restructure your properties, the way you own these properties over that 5 years, you would have to pay tax on any capital gains that you had. But then if you sold that property to yourself, you restart the clock. So let's say you get to the end of the 5 years of owning that property in your own name, you sell it to a trust, then if you wanted to sell that property 2 years in, again, you've got to pay tax on those capital gains because you've reset the clock. You had another 5-year bright line test. Now, what do I mean by restructuring? I mean, let's say you owned your property in your own name, and then you decided you wanted to actually move that into a trust because it was more secure. Well, you'd have to pay bright line, you'd have to pay tax on your capital gains over that period. Now you might be thinking, well, why is that? I was just moving the property from my own name into a trust. Why would I have to pay capital gains on that? And the reason is that if you want to move your property from your own name into a trust, into a look-through company, something like that, you have to sign a sale and purchase agreement. And you have to sell that property from yourself into your trust. And the other thing is that legally it has to be at the market rate. So you can't just sell it to yourself at the rate you bought it and try to avoid that capital gains tax, essentially. What you need to do is you need to sell it at the current market rate, and that means that the government can see your capital gains and therefore you've got to pay tax on them if it was within that bright line period. Now let's talk about how restructuring your portfolio looks after these changes are brought in. Well, the first thing, which isn't too good, that bright line period for any new properties you purchase gets moved out to 10 years. So if you buy a new property after 27th of March 2021, it's got a 10-year bright line test, unless it's a new build. New builds have 5 years. But the really good thing about these tax changes is that if you want to restructure your properties the way you own them within that period, you have rollover relief. Now, what that means is you can restructure as many times as you like, and you don't have to pay the bright line test. You don't have to pay tax. What that means is that bright line test does not move. It doesn't reset. You keep the same one. But I do have a disclaimer for you. That is provided that that beneficial ownership of the property stays the same. And we'll talk a little bit more about this when we get into some examples of when that becomes really important. But what is the key message here? Restructuring your property portfolio such that you can minimize your tax rate, such that you can lower your tax rate, that just got easier. Now let's give you two examples. One when you would use rollover relief, and then one where rollover relief's not going to help you. So let's start with when it would be useful. Let's say that you own your properties in your own name and you're a really high income earner. Well, your tax rate might be something like 39%. That's what you're going to pay tax on for any of your taxable profits on your investment property. Well, if you move that property into a trust, your tax rate will go down to 33% because that's the trust tax rate. Let's go through an example of what that means for the actual amount of tax that you're going to pay. Well, let's say you've got rent of 25k, operating expenses of 10. So you've got a taxable profit once all of the interest deductions are phased out, and we're ignoring things like chattel depreciation here, taxable profit 15k. Now, if your tax rate is 39%, you're going to pay 5.85k tax. Well, let's say you restructured. We're now in a trust now. What's changed? Our rent's the same. Our OPEX is the same. Taxable profit, exactly the same too. But our tax rate has gone down. It's now no longer 39%, it's now 33%. Now what that means is the amount of tax we've got to pay has gone down from 5.85k down to 4.95k. Now that is going to save us $900 a year in tax. Over a 10-year period, potentially 9k worth of tax that we're going to save just by moving the money around, just by changing the structure in which we own an investment property. Let's now talk about a situation where you wouldn't use rollover relief because it's not going to save you any money. Well, let's say that you've got a pretty typical structure like a lot of people in New Zealand. You own a property in your own name with your partner, But one partner, has a higher tax rate, maybe 39%, maybe they're a doctor, they're a really high income earner. The other person has a lower tax rate. Maybe they're working part-time looking after the kids. Let's call it a 17.5% tax rate. Well, when it comes to tax time, 50% of any taxable profit is taxed at the higher tax rate, under partner one's tax rate. 50% is at the lower tax rate, partner two's tax rate. Now, what that means in this situation is you'd have an effective tax rate of 28.25%. You're paying about 4.24k worth of tax. Now, pretty typical structure here in New Zealand is you'd move that property into a look-through company, and you'd put 99% of the shares into the lower income earner's name, and you'd put about 1% of the shares in the higher income earner's name. Now, what that means is that you pay 99% of the profits you'd pay at the lower income earner's tax rate, and 1% of your taxable profits, they are paid at the higher tax rate. They're taxed at the higher tax rate. Now, what that means is that our effective tax rate has dropped from about 28.25% down to about 17.75%. Now, that means the amount of tax we've had to pay has decreased by about 1.6k. Over 10 years, 16k worth of potential tax savings. Now, why do I say you wouldn't use rollover relief in this situation? Well, because the beneficial ownership, the ownership of this property needs to stay the same. So if you move this property into a look-through company under rollover relief, then you need to keep the shares the same. Now, what that means is that there's no difference. 50% will still be taxed at the high rate, 50% at the lower rate, so your effective tax rate hasn't changed, and the amount of tax you pay stays exactly the same. So you wouldn't use rollover relief in that situation, but there are some instances where it can be useful. Now, what have we learned here? Well, there are two critical learnings. First of all, rollover relief does provide some real incentives in order to be able to restructure your portfolio. You may be able to save some money on tax, but it is not going to be available for everyone. Not everybody is going to be able to restructure their portfolios in order to save tax. So what's really important? Speak with your property accountant. You don't want to be just implementing any old tax structure that I've shown you in this video because I'm just some guy on YouTube. What you want to do is get some advice tailored to your specific situation and make sure that you're making the best decision for you, because it is these situations where you can either make a lot of money or save a lot of money. There are some situations where you could potentially cost yourself if you move to what we'd call an inefficient tax structure. Now, if you'd like a recommendation for a property accountant, then check out our video of our top 5 property accountants, which you can either find on YouTube or you can find it on our website at opespartners.co.nz. And hey, make sure you check out our YouTube channel as well and hit that subscribe button, because this is only video number 3 of our 6-part series where we're talking about these interest deductibility changes from the governments and the new taxes that property investors are going to have to pay. And hey, if you're looking for something to binge listen to, check out the Property Academy podcast. Every single day we release a new 10 to 15 minute-ish episode to teach you something new about property investment. So you can find that on Apple Podcasts, Spotify, or your favourite podcast listening app.